Today, I'm going to be sharing with you guys 5 different dividend stocks that I'm looking to add to my portfolio this summer. These are stocks that I am betting will grow their business and as a result, reward me as a shareholder through share buybacks and juicy dividend payments. These are from brands and companies that you most likely recognize on a daily basis. Also, typically before I start a video, I ask you to subscribe, which is the same for this one, but also this is my first episode using the new microphone, and obviously the things aren't going to be perfect, so let me know your thoughts on the microphone quality right now. With all that out of the way, for the first time on Mac, roll the intro.
Hello, I like money.
The first stock that I'm going to be going over today is one of the most infamous retailers in the United States right now, which is Costco, stock ticker COST. Costco is actually a company that I haven't even owned in my portfolio until recently, and I am actually just still building up my position. Every Monday right now, I am buying $25 worth of Costco and building up my position, no matter if the stock price is high or if it's low. Currently, Costco is trading at $528.22 per share, which is one of the reasons I actually couldn't just recently buy in, because I just got access to fractional shares. Year to date, the stock is up 16.6%. Well, obviously, this is a reason that a lot of people are not buying Costco right now, and it seems like I'm one of the only people in the investment community that's actually buying the stock still. But with great quality companies, I've learned that it's not the best to sit on the sidelines and wait for a dip, so I am just dollar cost averaging into my Costco position all summer long. Speaking of valuation, they're also currently trading at a forward P ratio of 33.56. Again, another reason that people are avoiding buying Costco stock right now. This is a company I also will be adding to on dips as well. Why am I so fond of Costco stock right now though? What makes it so special from other retailers? In fact, a lot of people are actually not buying retail right now. Well, to start off, I would say it's their unique business model. To start off, they actually have a rewards and membership that you have to get into a Costco store. You can't just walk in if you're an everyday person. This allows them to really forge their business model so that they can have their members buy stuff in bulk at cheaper prices. This makes Costco really appealing because of the way cheaper prices. Another reason I think that Costco is really highly traded right now is because of the amazing financials that they have. Take a look at that revenue growth right there. It's literally as perfect as it gets. The same is with the EBITDA right there. The free cash flow also is amazing, and the net income has just continued to consistently go up. Right now in the stock market, investors want predictable companies that consistently grow their earnings. And I believe that Costco is just a pure example of one of those companies, which is why it's so appealing for me to buy as a long-term investor. Actually, Charlie Munger even said, if you're looking to buy Costco, just buy it now long-term. Their current free cash flow yield is 2.48%. Their current profit margin is 2.55%, but as I mentioned, this is due to their business model and the nature of their business. The real money is made in the memberships. We can also see that Costco has way more cash on hand than debt, which is a very good sign in a company. Costco also does pay a dividend. While it does have a very small yield, their dividend growth is nothing to laugh about at all. Costco's payout ratio is 27%, making that dividend very sustainable. Keep in mind, Costco also does pay special dividends. As I mentioned, Costco's dividend growth is incredible, with a 1-year dividend growth rate of 13.76%, a 3-year dividend annual growth rate of 12%, and a 5-year dividend growth rate of 12.44%, and a long-term 10-year dividend growth rate nearly 13%. This is an amazing dividend growth company to own, and over the long term, you get your yield on cost up. Their free cash flow per share growth is also a nice 5.36% as well. As you guys can see here, Costco does not do share buybacks at the moment, but they just announced a share buyback program. So I would expect those shares outstanding to go down long term. Now, share buybacks are a thing that I love in a company, as I like to own more equity in a company myself for not even paying any more, but it isn't a deal breaker for me not to invest in a high quality business. We can also see the large and consistent growth of that earnings per share, which is an amazing thing to see from a Costco there. Large and consistent. This is what the stock market wants right now and its winners, and that is why Costco is being up so much right now. Also, as I mentioned earlier, they have a very solid cash to debt ratio, so I would assume that their dividend is definitely safe right now, judging by that and also the very low payout ratio they have and the growing financials. As I mentioned, they do occasionally pay large and specialized dividends. Not a lot of companies do this, but Costco is one of those companies. T. Rowe Price also does it. This also isn't a deal breaker for me. I think it's a nice extra thing. But when Costco just has too much capital on hand, they don't know what to do with it. They'll just put it out in large special dividends or they'll hike that dividend. And Costco's expenses are going up as they are doing capital expenditures right now. But this I think is a good thing for Costco. They're trying to expand. Actually, me personally, they're building a Costco in my town, which will be pretty interesting. I recently just went to a Costco personally for the first time, and I was really amazed of how their business model flows and works. Also, another thing to mention, Costco is dealing with theft issues right now, which they are dealing with. Costco is also displaying great pricing power during this time as well, as they over time have grown their membership fee, and in turn, that has really grown the profitability. Right now, as I mentioned, I've identified Costco as a really high quality business, and I will be adding to it all this summer in weekly increments of $25. Now, if you're a fan of Warren Buffett, you are going to love this next stock that I'm buying this summer. The stock that I'm talking about is Union Pacific stock ticker UNP. Now, when it comes to me as an investor, there are a few things that I love. Free cash flow and monopolistic qualities in a business, and that is something that Union Pacific definitely has. Union Pacific is in one of the most highly monopolistic industries in the world, which is railways. Without railways, America really would not run the way it runs right now. AKA, America runs on railways, and they are the most important industry in our world when it comes to trade, etc. The importance of Union Pacific and other railways has allowed it to be one of the most profitable companies to invest in the world. This is why I've been adding my Union Pacific position so far this summer, and why I am planning to buy more. So far, over the last 1 year, Union Pacific is down roughly 2%. Their revenue is very strong, large, consistent growth there. Their EBITDA is the same, and their free cash flow as well is very strong. Again, guys, we love consistent free cash flow and profitable growth from these companies. Currently, Union Pacific is trading at a P/E ratio of near 18. Their price-to-book ratio is 11.39. Their free cash flow yield is 4.36%. They have 0% stock-based compensation impact, which is the new metric that I've been kind of looking at recently myself. That's really big as well for me. They have a near 28% profit margin, which is very solid for railways. Obviously, they have a lot of pricing power because the barrier to entry is so high in the railway industry, which is why it's more appealing for me as an investor. They have a near 39% operating margin, which is very impressive. Currently, their dividend has a yield of 2.54% and a payout ratio near 46%. Taking a look at more of Union Pacific's financials, their expenses are high, obviously because of capital expenditures. They have way more debt than cash, which is a bit of a concern for me though. Thankfully, this is part of the railway industry though, which is a big thing to keep in mind. Also, another big thing to keep in mind with the Union Pacific debt is they're using that debt to make more money. They'll eventually pay a return on investment for them that'll be very solid, and they'll eventually pay back that debt as well. So I wouldn't look too deep into it there. Also, with the continued growth and how strong their business has been performing, I would expect that debt definitely to be paid off. Union Pacific also has a very strong growing dividend as well, with strong high-digit growth rates. But there's more reason to believe that Union Pacific could have a lot more value in it, and this just came out a few months ago. The CEO, Lance Fritz, announced that he would be stepping down. This was in reaction to a hedge fund actually emailing Union Pacific in a letter telling them basically that the business was giantly misoperated and that there was so much more room for potential and better business execution. Now, with how strong Union Pacific's financials are now, it's crazy to believe that they could be even better. In reaction, the stock even jumped $20 or 10%, which for Union Pacific is crazy. Eric Mandelbot, who said in the letter, he basically told them they were behind their peers in performance past the 8 years, and that the hedge fund has privately pressured Union Pacific to get Lance Fritz out of the company. Union Pacific has repeatedly and significantly failed to reach its potential under Mr. Fritz's leadership, they said, and that Union Pacific was ranked worst in safety, volume growth, revenue growth, cost management, EBIT growth, and total shareholder return compared to their peers, which is incredible looking at their previous returns and dividend growth. With such stable and mature industries such as railways, you really don't expect companies to be able to grow even more. Union Pacific also performs share buybacks and rewards dividends in the form of that and a very growing dividend, as I mentioned. Even with the previous management and execution, I was still bullish on this company, and after this came out, I was very excited about the potential of Union Pacific and their execution in the future. If they can even get better returns that they've had in the past, I would be very, very happy, which is why I'm so eager to buy more this summer. So where am I looking to buy Union Pacific? I actually just recently bought some at $202. I like it at the current prices that it's at. If it continues to dip into the 190s, I will definitely be adding more to my Union Pacific position. One of the most profitable and biggest industries in the world is healthcare and big pharma. As mentioned on the Joe Rogan podcast, this is one of the biggest industries in the world, and with that comes a lot of profit, and with that comes a lot of dividends. One of the biggest pharma companies in the world, Abbvie, has been on a decline recently over the last 1 year, nearly down 16%. Abbvie is known for its incredible dividend yield and incredible dividend growth, but is that sustainable? Let's dive in. Currently, Abbvie is trading at a forward P/E ratio of 14.39, with a high free cash flow yield of 9.75% and a stock-based impact of that free cash flow of 2.88%, so it won't completely damage the company. They have a strong profit margin of 13.4% with a great operating margin of 37%. That great profitability, though, is ignored by the market right now as the stock is down a lot recently. The reason for this mainly is the Humira patent, which everybody has known forever has expired. People are worried that will significantly impact their earnings. A big thing to keep in mind is that Abbvie still can produce the drug itself and make profits from it, although it will be less. Abbvie has shown and proven, though, in their other business segments that this isn't slowing down for growth of their free cash flows. Going back to that dividend, they have such a strong dividend yield right now at 4.44%. It says here the payout ratio is 134%, but that is actually off. That's the TTM payout ratio. The cash dividend payout ratio right now is 44%, and they actually just grew it around 7% last January. Little note here for all, but whenever you see like a crazy outlying metric like that, when you see a quality business as well, always do your research into that. You can see below how strong they are financially right now. Beautiful revenue growth, beautiful EBITDA growth, amazing free cash flow growth, and their net income has continued to go up. This is definitely a business that I want to be invested in if that continues to go up. And obviously, I'm sure that the market is already pricing in the potential losses of the Humira patent. I'm sure in the short term there will probably be some loss from the Humira patent, but they are growing their other business segments right now, which I think will make up for all those potential losses. Abbvie's profitability will definitely drive them through this. Now, let's talk more about that Abbvie dividend. Currently, they have a 1-year dividend growth rate of 6.64%. Their dividend per share growth is 4.96%, but the long-term dividend growth is what's so special about Abbvie. To start off, they have a 3-year compound annual growth rate of 8.7%, a 5-year compound annual growth rate of 14.53%, and a crazy 10-year compound growth rate of 30.61%. Now, I wouldn't be expecting any more 30% dividend hikes, but I do think they can still consistently grow their dividend at a solid rate above inflation, but it really is incredible to see how strong their dividend is. Unfortunately, Abbvie does not perform share buybacks at the moment. We can see here that they have very strong earnings per share growth, which is awesome to see. They continue to grow and pay a very strong dividend. We can see here that they do have a lot of debt compared to their cash. Obviously, like Union Pacific, this is kind of in the nature of their business. They need to continue making acquisitions to expand their business to continue to make up for, that potential Humira loss. Right now in my portfolio, I do have a sizable amount of Abbvie, roughly $950, and I actually just bought some last week. I also do think that the risk with this stock is already priced in with the PE ratio right now, as I do think it is a very fundamentally strong company at the moment. With that said, I don't think Abbvie's dividend growth will be as large, but I do think it still will be solid and above inflation, as I mentioned. I think that Abbvie is a solid buy at these prices, and I will be continuing to average down if it gets below 130. For this next stock, we're going to Vegas, baby. The company that I'm, of course, talking about is VICI Properties, stock ticker VICI. To start off, VICI is currently trading at a forward PE ratio of 14.01, but as I'll get to, that is not the best way to value REITs. Their price-to-book ratio is 1.517. Their free cash flow yield is 6.91%, and their stock-based compensation impact of that is 0.64%, so nothing drastic there. It's always important that you really understand the business that you invest in, and luckily for us, VICI is one of the easiest industries to understand. They're in the real estate industry. Over the last 1 year, VICI is down 1.4% and has been on a dip recently. VICI owns a big portion of the Las Vegas Strip, which actually includes the recent MGM Sphere, which is the big, orange glowy thing. Big thing to keep in mind with Vegas as well is that overall area is growing, and as there's more tourists and more citizens actually of the city coming into the Vegas Strip, the tenants that VICI has that occupies those areas will grow their business and VICI will charge them more, allowing VICI to grow and allowing VICI to grow their dividend, which most importantly. VICI has really grown their business in the coming years, and a good thing is that they're not just in Vegas. They're actually expanding properties across North America and internationally. Currently, VICI's dividend yield is nearly 5%, and they have strong dividend growth rates, with their last dividend hike being around 7%. Their profit margin is 44%, and a big thing to keep in mind as well, as VICI does not actually get the money from the tenants. It doesn't matter how great the Vegas properties actually do themselves. If they get more tourists or whatever, VICI's going to consistently collect that cash rent. But I think as businesses grow and their VICI's tenants grow, they'll see that and they'll hike the rent. Continuing on, VICI has grown their earnings per share as well. Their cash to debt ratio is obviously high because real estate, they have to acquire new properties, take on more debt, etc. They are diluting shares right now to raise capital, obviously, because they're a real estate company. And their expenses have obviously gone up as they continue to acquire new properties and grow their business. Now let's take a look at VICI's valuation closer in depth. For real estate companies and REITs, you want to use price to FFO to really assess the valuation of their business. And currently, VICI is trading at a 12.83 price to FFO forward ratio, which compared to the overall, market and for real estate sector overall, that isn't much of a difference. So they're trading overall in line with that. You could obviously take a look at realty income as well, and they're trading near there too. VICI has actually been on a bit of a dip recently, and I have been buying personally, as I just bought 2 shares yesterday. If you want to see what I'm buying every day, you can follow my Twitter, Ryan Dengler Show, or you could join the Discord link in the description. When VICI is trading under $31, there's a good chance that I'll be adding to my position. I would like to make it up $700 to $800 within my portfolio right now, and currently I have like $500 worth of VICI. VICI is also set to hike their dividend and announce a new dividend hike in the coming months. And VICI is a great option if you want to get some real estate exposure in your dividend portfolio. And hey you, right there, do you want me to go over one of your portfolios? Join the Discord link in the description and message me from there. On to the video. And finally guys, the last stock that I'm looking to add to my dividend portfolio this summer is Kroger, stock ticker KR. Kroger actually just hiked their dividend 11.5% last week. Over the last year, Kroger is up 6.5%. Right now, they're trading at a forward P/E ratio of 10.91, which I think is pretty cheap. They have a 1.71% profit margin. I wouldn't dig too deep into this as well, as grocery chains are very slim profit margins, and their operating margin is at 3.09%. Right now, they have about $9 billion more worth of debt than they do cash, which is a bit of an issue. They are continuing to build new stores, and they also have that Albertsons merger possibly on the way. Right now, they traded a dividend yield of 2.49% and a dividend payout ratio of 29.89%, so plenty of room to grow that dividend in the future as they just did. Financially, though, Kroger is a very sound business. Taking a look at their beautiful revenue growth, they're just so consistent, but obviously EBITDA very solid too, and free cash flow is another solid metric there as well, with a slight decline recently, but we got to keep in mind stock-based compensation there. They have a free cash flow yield near 8%. I think the free cash flow really spiked during the pandemic in 2021 and 2022, mainly because of online shopping, and they've also seen solid growth in the net income department. Kroger's dividend growth is insane, considering that their payout ratio is still very low and sustainable. They have a 1-year dividend growth rate of 23.81%, a 3-year compound annual growth rate of 17.57%, a 5-year dividend growth rate of 15.77%, and a 10-year dividend growth rate near 14%. Keep in mind their payout ratio is still very low and they can still grow this dividend. That's incredible. I don't know how aggressive their dividend growth will be in the future, but I am very happy with that. Imagine getting a 24% raise from your boss at work. This is why I love dividend growth investing so much. I wouldn't expect, though, Kroger's dividend growth to be as aggressive, but I'm very content with the 12% that they just had. Kroger, I also believe, has a lot of potential in the future with AI and automation. I made a video going really in depth on that, but they have a lot of processing centers right now where robots actually, hand deliver your food. drones, all that good stuff. I'll leave a link to that video in the description. I would definitely check it out if you're interested in researching more about Kroger stock. It's one of the big reasons that I'm so bullish on it though long term as well. I think they'll have so much more potential to grow their profitability in a very thin profit business. We can see also Kroger has had very strong earnings per share growth as well. Their cash to debt ratio is very high. They do carry a lot of debt right now, but that is the nature of the business, a lot like a lot of these companies. If you didn't think it could get any better, Kroger also does perform share buybacks as well. I really like Kroger in the low to mid 40s right now. It's currently trading at around $47, $46 a share. If I see any significant dips, I will definitely continue to add. Kroger owns so many grocery chains that are really essential and that I don't think could ever go out of business. They'll also continue to adapt and adjust with new trends such as automation, robotic delivery, etc. And that, guys, is going to wrap up the video, the first ever video on the quality era, the Mac. Let me know in the comment section, guys, your honest thoughts on the microphone. Do I need to up the volume, lower the volume? I do still have some adjustments I got to make with it. I'm getting a foam protector on it, like the P thing, so my With that said, guys, if you made it this far, I really want to thank you. You're helping me reach my goal of getting monetized so I can continue to invest in new resources to grow the channel, grow the community, etc. If you want to talk with like-minded investors, join the Discord link in the description. Thank you again, and do dividend stocks, not drugs. Have a good one.